Hiring people, in my opinion, there's no playbook for it, and it's very difficult to manage people. We all have different personality. One thing I have found, though, through trial and error is that moving forward, I prefer to hire athletes. Their intuition to just want to compete, their drive, their motivation. You give them a task, they'll get it done.
I would say on private equity, they're managing billions of dollars.
Oh, yeah.
It's around generating solid returns. They're very, very talented at applying leverage to their deals and kind of de-risking it for their investors, even if the deal kind of doesn't generate the ultimate returns. But I will say they're not afraid to pay too much because of that leveraged approach.
Welcome to the Chris Salerno Show, your go-to for real estate, business, health, and family insight. I'm Chris Salerno, CEO of QC Capital. Each episode, we explore the latest trends and expert advice from industry leaders. Whether you're an investor, entrepreneur, or seeking balance, this show provides an inspiration you need. Join us and elevate your game on the Chris Salerno Show. Welcome to the Chris Salerno Show. I am your host, Chris Salerno, and I have someone special on, John Sutton. He's actually from Charlotte, a wealth of knowledge when it comes to business, so I'm excited to dive deep into his background. You're definitely going to want to listen to him. John, thanks so much for joining us.
Thanks, Chris.
I'm excited to have you here. Why don't we give the listeners and viewers a little background about yourself and then what you're currently doing right now?
So I spent the last 12 years, and what brought me to Charlotte was Red Ventures.
Okay.
So I joined Red Ventures in 2009. I had a small digital marketing agency in Chicago. And I
love Chicago, by the way. It's one of my favorite cities.
The summers, it's great.
Summertime's nice.
But I was 26 at the time, had done a bunch of different kind of entrepreneurial things when I was younger, and I met Rick Elias, who is the founder of Red Ventures here in Charlotte.
Okay.
And he kind of recruited me to come to Red Ventures. I thought I was selling him, but you'll find one thing about Rick: he's like the ultimate salesman.
Is he?
And so I thought I was selling him. He was playing.
I saw he just got ranked one of the billionaires in Charlotte.
Yeah, I think he's done really well with Red Ventures. I mean, it's a bootstrap business, so any business you can build over, a decade plus and kind of
stay consistent with it,
steady growth, and not raise a bunch of outside capital and give up your equity. I think you can.
There you go.
You can end up like Rick, but
love it.
So I joined in 2009. It was kind of a small business when I first joined. I mean, small-ish. He was still business probably worth $50 million, something like that when I joined. Mostly it was a telesales business generating customers for DirecTV and Clear. And I kind of came in to hopefully supercharge their digital marketing capabilities around SEO and paid search and some of the things I've been doing in the early 2000s. And I thought I was going to stay for 2 years and, kind of get my MBA from him and some of the leaders and then go do my own thing. And then I ended up staying there for 12 years. And it was a bit of a rocket ship when I joined.
Time flies.
70-ish employees, probably 50 of them were telesales when I joined.
Wow.
When I left, 5,000 plus employees.
Holy cow.
Maybe 1,000 telesales.
I mean, I will say, and we got a lot more of your background to get to, but touching on Red Ventures, you guys, they had a huge campus. I mean, they even built like an apartment complex, didn't they? For like their employees.
Still do. I would say one of the things that our CFO at Red Ventures, his name was Mark Brodsky, he was probably a little bit like you. Like he loved real estate. So some of the best investments he ever made personally and Red Ventures made was just buying real estate down in Indian land.
Because they have Redstone too.
Yeah, Redstone where the movie complex is, the apartment complex. And actually, a little known fact, but I mean, it's public record. The state of South Carolina gave a ton of tax incentives to the executive team, basically to the company.
To help boost the area.
Pass through on the equity side. To bring the jobs there because we were just across the border in North Carolina.
Correct, yeah.
And the campus of Red Ventures sits literally on the border
right
of
there.
North Carolina, South Carolina.
Oh, yeah.
And so, I mean, it was beautiful. A big part of the culture. And I think what kept me there for a long time was, young people, young energy, a lot of passionate people coming from the great universities around Charlotte.
Oh, yeah.
And the campus was about kind of, creating that culture of people that wanted to work together. And so I think COVID was a tough time, and some of the M&A that we did towards the tail end. So I like to say it's like one of the, probably the biggest media company you've never heard of would be Red Ventures, because I think it's number 5 most trafficked websites if you kind of combine all the assets Red Ventures owns in the world.
Wow.
So I think it's just north of Yahoo and some other domains. So most people don't know that, but like cnet.com, tvguide.com, pointsguide.com, bankrate.com, healthline.com. A lot of these assets are owned by Red Ventures now.
No way.
And so I spent, the tail end of my career doing a bunch of different things on M&A and learned a ton about investing there. And then I decided to retire in 2021. July 21 was my retirement celebration.
How long did that last? You don't seem
I
like
thought
the
it was gonna last a long time.
you don't seem like the
but-
guy to retire. I don't
You
get
know,
that vibe.
maybe it was my midlife crisis. I'm not sure. I was turning 40 that year. I was having my second child. And
Congratulations.
thank you. And I had like my bucket list, like a lot of people, and I just felt like we were doing great things with Red Ventures. I really love Red Ventures still, and the team there. Or in being in Charlotte, like we have a lot of great entrepreneurs who've kind of come out of Red Ventures too. But it just felt like I was doing the same things and not getting to the things I wanted to accomplish on my bucket
okay,
list.
yeah.
And one of those was I wanted to play professional beach volleyball, and so I went and played.
That's different.
Yeah, I did a deal with the best player in my opinion in the U.S. This guy Phil Dahlhauser.
Okay.
Said like, I'll teach you business if you teach me, volleyball and play with me. On
There
the
we
tour.
go.
And we did some good deals together. I played with him in 4 professional AVP events. We kinda
Professional volleyball.
got into the top 12. It was fun, and so that was a bucket list item. And I thought I was gonna take more time off, probably like a lot of people do
Yeah.
when they leave. And I ended up kind of jumping into. I either wanted to get into venture capital because I love the pace of innovation and like just seeing new things. But I talked to a handful of friends, and they're like, based on what I told them, they didn't think that's what I wanted to do.
Okay, interesting.
And partly it was I love building things.
Yeah,
And the
it's
tricky
fun.
the tricky part with being a VC is, you have these great ideas for the entrepreneurs, but like your job as a VC isn't to kind of give them those great ideas. It's really just to kind of guide them and be there.
Correct.
When they
Be an
ask you for
advisor.
help. Yeah.
Yeah.
And so I thought I wanted to be more of a principal. And so
Okay, more hands-on.
I didn't know what category, but I think the way we ended up getting connected was I just felt like real estate. I was on the board of directors of a company called Zoopla in the UK that Red Ventures had acquired. And it was like my first taste of, I'll call it PropTech, if you want to
Got
call
it.
it,
Yep,
a category that hasn't existed. But Zoopla is like the Zillow of the UK.
Got it.
And it just felt like real estate was one of the categories where technology and kind of where the consumer
lacked.
was going, it just wasn't there yet.
It's old school at the end of the day.
It's still very old
It's
school.
still
and
very.
even like the Zillows of the world, I would argue, like I give the corollary of, we'll see what happens over the next 10 years
Yeah.
with some of the advents of technology and the NAR rulings and things on residential real estate. But, Zillow was like, if Expedia had decided we're going to disrupt travel by, letting you search for flights, getting you to the last minute and being like, okay, great, let us connect you to a travel agent now.
Oh, for
And
sure.
like, that's kind of the Zillow experience.
Yeah.
And so when I was lucky to meet this guy, Eric Wu, who was one of the founders of Opendoor.
Okay.
And, love him or hate him, I think the one thing that Opendoor really cared passionately about was like trying to create the one-click buy the house like experience.
Oh,
Like, that was
100%.
that was their vision.
And in certain circumstances, you have those individuals, individuals that are going through a divorce or having, maybe a death in the family where they want a one-click, forget about it, I'm done, I just want to leave it, no hassle. And that's what, Purple Door, Open Door, and there's a couple other ones. Zillow tried to do that, but that's what they did essentially.
Listen, in real estate, it's one of these ones where you don't need to, I would say, like own the market to have a
Correct.
very big company.
That's right.
And so, I learned a lot, positive and negative, on Opendoor's model that kind of influenced where I kind of headed next. And so when Eric stepped down as CEO of Opendoor, I stepped down as an advisor as well. And he encouraged me to lean in fully to this idea. I'd been incubating a bit in Charlotte with my own real estate assets that we call Mansion Group.
Yep.
And the concept was, I saw kind of a growing trend of more and more people, at least like myself, who have young families who prefer to stay in hotels or in homes instead of hotels.
Yeah.
And it's just an easier experience when you're traveling if you have little kids.
Oh,
You
100%.
You haven't experienced this yet, but eventually you will. And so we started buying kind of single family homes around core urban markets where at least like the risk profile for us was, if we're wrong, and we could just sell it as a single family home. And we wrapped it. Our vision is to create a Hilton or a Marriott type brand.
I love
where
that.
we're the operator, we're the playbook, maybe we're the franchisor of kind of that playbook. And we help real estate investors and developers get the most out of single family assets,
Most definitely.
specifically the ones we target. And so our first brand, Mansion, is more like an upscale luxury brand. So we target kind of higher end homes,
Yeah.
3-4 bedroom homes.
Let's talk
that's
more
the
on
vision.
that. With my son and I, we just stay at hotels now, and it's fun. I like room service. I like that. But with a couple of my buddies who have families as well, I've talked to them, and if we're going to Disney and taking the kids to Disney, it's like, hey, why don't we just rent a house? and we're all in the same house, because if we're all having a hotel room, it's not fun, it's just three of us in one, hotel floor. It's more enjoyable with that house. So let's talk about the short-term rental side of things. Where are you guys locating these assets? What really, and what drove that decision on that type of criteria that you guys have?
I mean, I would say we were lucky that Airbnb has been building this business. The vacation rentals have been around for, decades.
Ever, yeah.
But primarily
It's just
now
the technology has made it public, basically, essentially, to everyone's fingertips.
And I would say vacation rentals were really oriented around vacation markets.
Yeah.
So
the mountains, the beach.
The biggest difference today is you can come to Charlotte, North Carolina, go on Airbnb, and find
tons.
a house for rent.
Oh, yeah.
You wouldn't have found that pre-Airbnb, really.
No.
There may be a handful, but that wasn't a concept.
No, it wasn't.
And so, we're riding a bit of the tailwinds of the investment Airbnb's made. I would say the one thing I talk to a lot of investors about this in our funds is, Airbnb is a marketplace. It just happens that they make very good money, and they're kind of driving the marketing for us. In terms of the consumer, I think there are tailwinds kind of coming out of COVID, but also just more and more people that have experienced what you described, like staying in a home. And it's not for every travel occasion, I don't think. When I travel for business, I'll stay in hotels by myself, of course. But I do think there is a group dynamic where people want that experience of getting together. And, for me, when I talk about having small kids, we put our son to bed at 7:30. So if you're in a hotel room, that means you're going to bed at 7:30.
Correct.
Kind of on your vacation.
You can't, what are you going to do? Go out to the lobby and hang out?
Exactly. And so I think that's a big driving force. And then I think some of the younger generations too actually prefer to travel as groups.
They do.
And so that's kind of the other big ICP.
And it can cut down costs sometimes, depending on
per bedroom
what type you're staying
at. Or you
at.
get a better is a loose term, but you get a different experience for that
Oh,
investment.
for sure.
So, our average daily rate for a home that sleeps 10 people is probably $750. So if you said, per person, it's $75 a night.
Not bad.
It's competitive with, mid-market hotels.
Yeah.
But it's an upscale experience.
I mean, you're not going to find a good hotel for $75 a night.
No,
Let's just say it. It's going to be a motel.
You're sleeping 10 people in one of our houses. You're sleeping 2 people in every bed. So we'll see what that breakdown. We'll call it even bedroom. And so I think, the thing for me about brand building, though, is that, you're an investor, so I think a lot of our heads goes to the numbers. I actually think for a lot of people, it's part numbers, but it's also emotional experience. So, the reason we went with a luxury brand to start with Mansion is we want to create an experience people are willing to pay a premium for. And so,
people are willing to, if it's an experience. If it's a good experience, they're willing to pay a premium, just like first class compared to economy.
Exactly.
Especially when you fly overseas. I've flown both, and trust me, sitting in a pod's a lot better.
Yeah, that's fair. So, so that's the vision for the business and the brand. And short-term rentals have, I would say, have gotten some bad press, just depending on it. A lot of it's driven by the hotel lobbies in the industry. If you look at what happened in New York City, where they kind of basically flat out banned all Airbnbs.
Oh, yeah.
And the storyline was that Airbnb, kind of short-term rental hosts and investors, were buying up kind of all the available properties that could be rental properties or could be sold to primary homeowners. But that was a narrative driven almost exclusively by the hotel industry.
It's fake news.
Yeah,
at the end of the day, it's fake
outcome
news.
of the ban was basically rents went up. So this idea that rents were going to go down when investors couldn't buy short-term rentals anymore was false narrative. The other one was that hotel prices would go down because they had to raise their price to make more money, and the reality is hotel prices went up.
Oh, it did. And I just stayed in New York last Thursday just for one night. And I always like to see the itemized bill to see what they tack on. And it's unbelievable. The city tax, the state tax, and then on top of that you have an additional $50 hotel fee.
Right.
And it's why am I paying an additional $50 hotel fee? They just start tacking on all these little fees. And so at the end of the day, it's okay, my $400 or $500 a night hotel room's not actually that. It's actually $600-700 a night after you tack on all these little tiny fees.
And listen, I think you've seen some markets. I think regulation generally, if you're building a business like Mansion, can be a good thing for us because we can make the investments in making sure we follow the regulations. But I think intelligent regulations. We met with the city of Charlotte when they were going through the UDO.
Yeah.
And
that crazy UDO.
They were talking about short-term rental restrictions. Some of them were fairly asinine. But when you sit down and talk to them about what they were afraid of, I think you can talk logically about okay, we don't want to turn neighborhoods into transit
party
locations
houses.
or party houses. Here's the protections you could put in place that we do. So we have noise monitors in all of our homes, so we proactively monitor how many guests are connecting to the Wi-Fi,
Yeah.
how passively, how many, what's the decibel level at what time. And so these things are not major investments any host would have to make, but like it takes a sophisticated, operator to do it. And so I think we've kind of encouraged the city. To answer your question directly, we're in the city of Charlotte right now, primarily.
Which is a phenomenal market, and it's only growing even more.
Yeah, I mean, maybe we got better lucky than good, because this is where I'm based
You
out
live,
of.
yeah.
And so, yeah, it's been a great market, but we've also targeted, so we're looking to expand to other tier 2 cities, what we call them. We invest in we call core urban markets. Part of it is the underwriting.
And I love that. I love that. And we were chatting about another company before that, and we were talking about strategy a little bit. And tell everyone your strategy behind that, because I love that option of an exit just in case if you need to.
Yeah, I learned a lot of this from Rick Elias, but I had this belief that I said if we're going to take anybody else's money other than my own to invest, like I want high confidence we're going to give them more than they gave me back.
Yeah.
And so part of that drove our underwriting strategy on the type of assets we bought. I think we saw a lot of competitors in the short-term rental space who can do pretty well on the revenue standpoint, buy a home, make it kind of look like Disneyland in the backyard, graffiti walls, and a bunch of amenities. It doesn't cost a ton to do that, and it is visually attractive for people that are coming.
And
to
it's
visit.
fun if you and I are taking our kids there. Keep them busy. Hey, go play cornhole or something,
which is great for revenue. The challenge is when it comes time to exit that asset.
Who you gonna sell to?
It's basically an investment asset only. And
Correct.
then depending on how it's performing, there's not really an institutional buyer yet.
Correct.
In the short-term rental space, and so. It's hard to say like, oh, it's going to trade on a cap rate. Here's the fair cap rate. It doesn't really work like that yet in short-term rentals. And so we kind of took the underwriting stance of saying like, we'll be a little bit more conservative.
I love that.
Our buy boxes, we're going to add nice amenities. We'll try to make the backyard have something. We had a property in Florida that, had a pickleball court, and, we'll put in grills and outdoor, and we have 2 rooftop hot tubs and properties in Charlotte. But there are amenities that like a primary home buyer would also like.
Correct.
And so I think our thesis was core urban markets that have a balance of population growth, of business travel, of event-based travel, of kind of tourism. Our CFO could share the full underwriting, but basically the idea is, we are not banking on any one thing to make the business work. And because we have 5 to 7 year horizon on kind of our whole period on the real estate fund, we said, if we're wrong, the market will appreciate based on 10-year average, 20-year average, whatever will happen. And Charlotte's had pretty strong performance over the last 5 years.
And rates will go down eventually. And I love that thought process approach is you have options. And I'm an options type of guy. I like to make sure I have options. With our car washes that we're buying, we own the real estate as well. And just in case if something happens, I'll sell off the real estate as a triple net lease, keep the business, have it cash flow, and now we just recoup some capital, to pay back investors or whatever we need that capital for. And so it's great that you guys have that approach, because you and I both know there's some companies out there that, I scratch my head and I'm like, well, what's your true exit strategy? Because there's not large private equity companies in this space yet. And will there be? I don't know. Is it your Hiltons, your Marriotts that may say, okay, we want to acquire them? Because I've noticed Hilton and Marriott now has luxury rentals.
Yeah.
So, are those the buyers down the road that says, hey, we'll acquire your whole fund with, each individual property spread out? I don't know.
Yeah, I mean, I think the challenge with short-term rentals for the big guys right now, like Marriott launched, I would say closer to like an Airbnb competitor called their Homes and Villas.
I mean, they've been around for what, 5 years, 6 years they launched that?
Yeah, I think that's about right. And it's been growing pretty well, but it's basically a marketplace. So they have some different criteria to join it, but like we could put our assets on Marriott if we wanted to.
Oh, so it's like a platform like Airbnb.
Yeah, exactly. But you have to meet different criteria. So, they've set the bar a little bit higher.
I wonder how many people use their like Marriott's points, those high travelers. Like I use Amex, so all I use is like Amex everything with the points. So I'm sure a lot of people use that for those.
I bet like that's actually, we can talk about it separately. We're building, I think, the first of its kind rewards platform. We're calling it Journey Rewards.
I love that.
We're likely going to spin it out of Mansion and kind of let it be its own thing.
Will you?
It's going to be the public announcement of it, I guess, or we'll edit it out later. But
there we go.
Yeah, we saw the same thing though. Like Marriott, the one big benefit of Marriott Homes and Villas is people that have points can use their points.
Because it's that reoccurring that you're going to basically have amongst your clients and your customer base is that trust, and that they're more than likely going to come back. That's why people do Starbucks, and have those points and reward system.
Yeah, I think we were chatting a little bit about your car wash brands, but I think part of the investment we've made that separates Mansion, and it's very early, like we're a seed stage company, arguably on the operating company side, but I really believe over the next 10 years, someone is going to create a brand around homes versus hotels, like just like a Hilton or a Marriott or a Kimpton, or pick one of the smaller ones even that have done. And I think, our game isn't to be quote unquote the boutique hotel where every property is completely branded something different and there's no kind of, I'd say, like central operator or central brand that wraps it in it. Because I think what people are missing in Airbnbs today is like they want that consistency. I like to say, like, I've had the best experience of my travel life in an Airbnb and the worst experience of my travel life in an Airbnb.
I have the exact same. I've had a host cancel on me when I was at the front door.
Yeah.
Because he didn't want to, or I think he was busy or had a place to stay. He canceled on me right at the front door. And then this was like after a full day of travel. It was like 11 p.m. in the evening. I'm like, okay, I'm done. I'm going to a hotel.
And I think that's what led me to say, okay, somebody can create a more consistent product.
Correct.
And it doesn't mean that every property is the same. I like what Bill Kimpton used to do with his hotels, where often he would kind of roll up boutique hotels, but they would bring kind of local flair, kind of the personal touch.
I love that. Yeah.
Local people who are kind of in the hotels. He personally would kind of sit down. And if you've ever been into a Kimpton hotel, a big part of it is like the lobby where it 100%. Feels like home.
And that's what Grand Bohemian does too.
Yeah.
If you go to the Asheville one, it's more hunting, outdoor theme. You come to the one here in Charlotte, it's art, the Charleston one's artsy. And then here in Charlotte has like a mixture of it.
Yeah.
But if you go to Charleston, they have a whole art gallery in the Grand Bohemian.
Yeah. And so I think that's what we're trying to do. We'll see.
Yeah.
But what I was going to say is I think a brand, it really is about creating trust over time, but you're trying to build that relationship. And where we need to be 5 years from now to be successful with Mansion is we have to have customers who are seeking out Mansion, or are part of our CRM, if you will, or our loyalty program is going to be a way to bring those people together. And so that they feel like, okay, next time, even though the first time they found us was on Airbnb, next time they'll just come to Mansion because they know they need it. Now, the trick in our business is we need to keep growing the real estate assets so that we have more dots on the map.
100%.
Because if we're only in Charlotte and you only travel to Charlotte one time for an event, it's not very helpful to do
Correct.
that.
And why would you do it?
And that's a bit of our thesis is we're going to grow slow and steady, but we're going to try to this year. Our goal, we're in conversations. We have our Reg D fund that's open now.
Yeah, congrats on that.
We're working on kind of some family office deals, but we're going to try to probably put between 30 and 50 more homes out there.
Love
that. We have 17 right now. And, we don't have to hit those numbers. Like I said, we'll be methodical and make sure we're diligent with our underwriting, but I think that's our growth goal. But we're not trying to boil the ocean. We talked briefly about the kind of VC-backed companies.
And I want to touch on that. That's my next question. Is we were chatting about it. VC in real estate. I've noticed, especially in the car wash sector, some VC, or not VC, but some private equity has came into the car washing space, and they overpaid 8 months to 12 months ago. Overpaid substantially. And we chatted about that. Is that when they both get together in a relationship, both private equity or VC and real estate, they really don't mesh pretty well because the private equity and VC people want it now and they want it done yesterday, where real estate is like a game of Monopoly. We are going to take our time playing it. It's how it is. What's your thoughts on that?
Listen, I have some really good private equity friends, which I think private equity and venture capital certainly are different. I'll tell you my opinion on the differences, but I don't know the car wash investors that well. But I would say on private equity, generally they're managing billions of dollars, right? And so in that case, it's around generating solid returns. They're very, very talented at applying leverage to their deals and kind of de-risking it for their investors.
Correct.
Even if the deal kind of doesn't generate the ultimate returns. But I will say they're not afraid to pay too much because of that leveraged approach.
Correct.
And so we'll see what happens. But like Red Ventures took private equity for some of the secondary deals we did, and I think if you get the right investor
partner,
they'll be patient and they have access to tons of capital, and they can generally, if they're coming into a category, I wish private equity, just to say it differently, I wish private equity was looking to come into short-term rentals because I think they would look for operators like us, maybe
100%.
like eventually like you guys, right?
For sure.
they want somebody they can have confidence will help them generate the returns, and they're happy to pay you to do it.
Most definitely. And I think they will. I think it's still new. Same with the car wash sector. Even though car wash has been around since 1940s, it's still new to them. And with the tax benefits and with the high cash flow, they're now catching on. And now you're seeing a lot of money flood into it. They just unfortunately bought at the wrong time with high interest rates, Yeah. But you're right. Private equity, those large institutions up in Wall Street or wherever, Chicago, you name it, the ones that are accepting institutions, they can get penalized if they don't deploy that capital fast enough. So they're trying to deploy it as much as possible. And I think you're right. I think it's new in your industry, but I think they're going to catch on because people want that different type of lifestyle, not just the hotel, the cut and paste. They want that local experience and approach.
Yeah, and listen, I think all of us, venture capital, private equity, even me personally as an investor, we're all susceptible to the emotional aspect of that investment we're making too.
Oh yeah.
And so for us, and I've always invested in things I know and use, and it's served me well enough.
There you go.
To date. So I don't do mobile home parks that can make a lot of money.
Not Bitcoin,
or RVs, or Bitcoin. Long story. I'll tell you a different time on the Bitcoin one. But I think on the short-term rental side, same. Properties I like to use, and I think investors who invest with us, part of it, they like the cash flow, they like the tax
100%.
benefits, they like the security of it being real estate versus crypto or something else.
Oh, yeah.
That has more risk. But they also kind of like, and I would feel comfortable telling my friends about it.
Oh yeah.
And so we try to add that element. Talking about the VC side, though, I think it's a little bit different.
Mm-hmm.
The challenge that I've learned about venture capital, and I don't want to talk about an entire category, but I'll tell you just generally speaking, the way I thought about it is a lot of venture capital firms are on this cycle where even if a typical VC fund probably is at least 10 years, right? They have maybe 3 to 5 years to deploy, and then they're going to capture for 5 years, and they're hoping 1 in 100 of their bets is 100x or more,
is a home
right?
run.
And then they bank on the rest being worth 0. In fact, they would prefer they're worth 0 versus they kind of just stay along for a long time.
For a long
and
time,
so
yeah.
because they're trying to get that 100 extra that will return their fund. And the way they do that is they really push you to deploy capital quickly, raise more capital.
Mm-hmm.
There's 2 reasons they want you to raise more capital. One is
because you're normally going to raise at a higher price.
Yeah, they want to make a mark, right?
Correct.
So, and the reason they're making their mark is I'm probably wrong. Somebody has probably done it, but most of these VCs, even though it's a 10-year life, they're raising their next fund within 2 or 3 years.
Automatically.
And so they need a mark to say look, it's
we
early,
bought in
it's
at
pro forma,
Series
but
A at $1. Now they're selling at $2.
Yeah, but it's it's not DPI, right?
Yeah.
So they haven't paid it out.
No.
And so I think it's whatever TVPI or something. So I think the way that we thought about in real estate is if they're pushing you to raise capital for your operating company. So forget real estate because generally they're not comfortable letting you raise capital for real estate.
Yep.
It's for the operating company on equity is what are you going to do with that equity? Okay, you're going to hire more people, you're going to build more tech, you're going to build ahead of the curve, and then maybe you're going to go try to buy a bunch of homes, in our case, right? Well, that's not always a great strategy, like we were talking about, is putting a bunch of dots on the map in a very short period of time before you've realized the mistakes you might make in your underwriting, or a given market might have a massive change or something that happens, or interest rate environments change, et cetera. And so our belief is VC and real estate don't go well together.
Yeah.
I like that business, but I think they got caught in one of those ones where they were buying
Crazy
too many
crap.
homes in too short a period of time. And it's great business, good margins, overall, great team. But that one mistake a 30-day mistake almost brought the business down.
Oh,
right?
yeah.
Had some really, really bad, tough quarters. And, I think now they've kind of realized, okay, we don't need to, boil the ocean and be,
you have
10%
to be,
of a
you
market.
have to be careful. Like what I said with Red Lobster, they are going through bankruptcy now, and it's because they decided to have a $20, shrimp all you can eat, and then they ended up losing over $11 million just from that, and that tanked them. So doing that like Opendoor did, it's very close where it can tank your company.
Maybe I don't know the Red Lobster, I don't know my shrimp economics that well, but I will say that I think the idea of making a huge bet, and when you talk about real estate, you're talking about billions of dollars of capital, right? That's the nuance.
Look at WeWork signing all those leases.
Yeah, the master leases. And we actually, with Mansion originally, I would say there's 3 ways to build our business. One is, the WeWork style.
Mm-hmm.
There's a company called Sonder that does it for mostly apartments, if you've run into them. But, they'll go to a multifamily owner and they'll say we'll lease
couple units,
20 of your units for you.
Short term,
it locks up. You don't have to worry
corporate.
about occupancy. Exactly. Kind of like corporate leases, except for daily instead of monthly.
Yeah, we've talked to a couple of them with ours.
But they're master leases, generally 2 years, maybe a little bit longer. But the way a master lease works, a lot of risk on the balance sheet for that company because if you don't occupy the place, you still got to pay the bill.
Correct.
And so WeWork got caught with. That's why bankruptcy is probably great for a WeWork because you can cherry pick the assets that work and those that don't.
A lot of people don't realize that.
But, I think it certainly is risky.
Very much
you're
so.
in a long-term deal and you don't really know. You don't have the data to know if you're going to be able to do it. So you're kind of just underwriting based. The other in our case is like a property management business where you don't own any of the real estate. You don't get any of the upside of the performance of the asset. But you don't take any risk. And so the challenge with that is it looks to me like I was in the digital marketing world for a long time at Red Ventures, and it looks like an agency. So the challenge with agency business, my very first business was like real business outside my dad and I's was a digital marketing agency.
Yeah.
And oftentimes you have something that differentiates you, but doesn't last very long because other competitors come in pretty quickly. Think of like a paid social agency, and it's like, oh, we can do that too. Like we can see what you're doing. We'll do the same thing. Oh, we'll do it 1 point cheaper.
And a lot of people don't know is actually on Facebook, you can go into page transparency of your competitors and see what type of ads are running.
Oh yeah,
we've done that so many times, but you also have to go in and switch up your ads to get new things out there. Because if it's this old and it's boring at the end of the day, that's something you stay consistent with to a certain extent, and then you have to put out new type of visual ads to catch the naked eye of individuals.
Yeah, and so in that social example, the agency world, and so in our case, it'd be like a property management company. If you charge 20% today, 2 years from now, you're charging 18. 5 years from now, you're charging 16. So you see kind of margins degrading.
Yeah.
And so we decided let's do a captive approach. So like your car wash business, we're the operator. And we have a PropCo. So it looks a lot like hotels. So hotels, generally, there's a real estate investment group that owns the real asset. And then there's kind of the operator. And then separately, there's the hotel franchisee or franchisor who franchises it to the operator. Right now, we're all three. But we envision a world where we don't need to be, the PropCo funds necessarily if an investor wants us to operate their assets.
And that's good because it, again... And I think you and I are very alike. Again, it gives you options. So when you sell, you can sell one of those, and you can retain the other two. You can sign a contract between all three, and then retain the other two. Sell one, and there you go. Now you have two other businesses. You have you can sell them off individually, or portfolio and put them all together, and then sell them off.
Yeah, I agree. And then listen, I think you have done a brilliant job of kind of bringing digital marketing to a space that for a long time. People were buying paid social ads, but I think they weren't digitally native. They weren't thinking about how do you really maximize these mediums. And I agree, social, not enough people use the ads library within Facebook to see what other people are doing.
Oh, we look at it all.
Right.
I look at every single one of our competitors. What are they saying? How are they saying it? I go and click on it. How is it performing? Now, I can't see their metrics, but I can see, oh, wow, they have, 5,000 views. Well, when was the last time they posted, this was, when did they start this to go active? Yeah. I think that's super important because that's how, and that's why we do these in-person podcasts is back in the day, you and I would have to host a meetup event or go down to the local country club or have a cigar with someone to then meet people, where now we post this and have 10, 20,000 people looking at it.
Yeah. I mean, the world is certainly changing. And I think even the accredited investors that we both kind of target for our funds are on digital media because they're probably 30-year-olds, 40-year-olds that, are entering that, maybe younger, hopefully. But
I'm shocked.
The media hasn't changed.
Oh, no. I'm shocked on our investor base. A lot of them are in their 60s and 70s. And And I'm like, what are they doing on Facebook?
They're finding your Instagram.
Yeah, they're finding us on Facebook, Instagram. And I'm thinking, wow, they're 60, 70 years old.
Yeah.
And they're on social media. And I think social media, one, will just suck you in. I think it does something to the mind, gives us that dopamine where we're just sucked in, and then it's like, okay, you got to get off. But it's the new era of marketing. And if you can't master social media on that end, and then also that other branding approach like we discussed, I think, you're going to be limited on how far you really want to grow and take your business to the next level.
Yeah, I think another change that's interesting is, you tell me if you're seeing the same, but we're seeing more and more people that are managing their own money. And so, when I was a kid, my dad, I think it was Edward Jones or one of these wealth advisors or investors, And I think they have great businesses. And for those who don't have the time,
Yeah,
but I think we're seeing more digitally native people, whether it's their whole portfolio or a chunk of it.
Yeah.
They're saying like, I'm going to manage it myself
Correct.
for these types of investments. And those are the ones who are generally calling us on the Reg D fund that we
Most
run.
definitely.
And I think often you're right. Like they're finding us on Instagram ads or Facebook ads or SEO or something where they're kind of doing their own research. And I think, there's even more to catch up on that. Like, how do you make that a better digital experience for those investors?
I think,
and we'll see kind of platforms evolving to make that better.
I definitely think it's coming down to the systems and processes. I mean, we deal with only accredited investors, and some of our investors are like, look, I don't even want to sign the legal docs. I'm like, no, you have to. Like, we have to make sure everything is signed and all that. But they want to make sure it's a quick, streamlined process. You have to look professional, and you have to be very responsive. And to touch on your point, investors want that diversification. They don't want to just be locked into the stock market. Who knows? Is it the current presidency, that we're currently in right now, where they're weary about what's going on? Possibly. They're not confident in our stock market nor our government right now at the moment. So I think a lot of people are looking for that diversification where they are handling their cash right now and they're placing it where they want to place it.
Yeah, I think that's true.
I hope you're enjoying today's episode. Just a quick reminder to make sure you never miss an episode. Stay connected with us by following us on social media platforms, Instagram, Twitter, Threads, TikTok at Chris_Salerno_. And don't forget to subscribe to YouTube to catch the video versions of our episode. You'll get exclusive content, behind the scenes footage, and much more. Head over to YouTube, Chris_Salerno now, and hit the subscribe button. Stay tuned because we've got more great content coming right after this.
And I do the same personally. And I think more the SEC has done a good job allowing us to kind of open these 100%. Up for Reg D and even the Reg A that we launched, late last year. But I think having access, you guys do know Masterworks, the people that kind of do it for art.
Oh, I've seen that. Yeah, they are like an art syndicator, and they do it for art. I think I've seen that. Yeah, or someone's told me about it because their returns are stupid, crazy. And I'm like, I don't know art to that extent. Exactly. Where
I don't think either of us are giving investment advice, but I would say the Masterworks thing was really interesting to me because, like, I've seen art in museums. I kind of understood that like really wealthy people, which I don't kind of categorize myself as we're buying art. I didn't really understand the math of it, and it's an interesting one of those assets where, it's set. The market is set by the next sale. It's kind of like real estate in that regard, right?
Yeah.
Like,
what's a buyer willing to pay for?
Yeah, and it's in some cases it's not even that asset. It's like, well, it's the same artist. Here's a separate asset. Look, it set a new mark, and like now your asset jumps up in value. And so, if you can hold this physical asset, it's fairly transferable.
And mainly, it's one of one. So, there's no duplicates because if you make more, that devalues what you have. And, it's set with whatever the next buyer's willing to pay for that.
Yeah. And I think this idea of fractionalizing anything, like whether that's how you think about your world or not, like you fractionalize the ability to invest in a car wash.
Yeah.
Versus when I was a kid, I told you this too, where I grew up in a small town in Indiana, I'm pretty sure just like the local family that did pretty well owned the car wash. And they owned, they had to have all the capital to buy the car wash.
Correct.
And everybody felt like I could never do that because I have to have $2 million to build this car wash. But now I think there's a world where you can have exposure to that. Maybe there's some additional fees that bring down returns slightly, but it's also way less risky because you only have to put up $50K or $100K or whatever it is instead of $2 million in that one asset. And so I think we're all kind of bringing more of that kind of diversification through fractionalizing different asset classes. And I think we'll wake up probably soon and there'll be more of these wealth advisors, et cetera, giving people exposure to those asset classes.
I think regulations will change. We have two pretty decent sized hedge funds that have invested in our fund, and we're actually at the moment looking to get on Charles Schwab's platform so we can actually present our offerings to all of the members with Charles Schwab. And I think that you're going to see a lot of these larger institutions either create platforms or start to market even more heavily to fund managers like yourself and myself to offer their clients that diversification. Because what if they don't? If they don't, because Joe Smo or whoever wants to invest in your fund or mine are going to keep telling their wealth manager, hey, transfer money to here, transfer money to here. And then these larger institutions like JP Morgan, Chase, you name it, they're saying, we're losing money.
Right.
We're not managing their money. Why don't we open up this other platform, which if you're listening, you should open up another platform that is a private sector where your clients can actually choose any type of offering from the private sector, and you can still, manage their money, quote unquote, and get paid for it.
Yeah, I'm surprised. I'm with you. Like, we should chat more on the swap
Let's
thing,
do
but
that.
I'm surprised that doesn't exist yet, and maybe I'm just not sophisticated enough to know it. But I do think that we've both gone
Maybe
through
we create a platform.
Yeah, that's true. I love platform businesses.
Let's do it.
But I do think like the Reg D is a fairly straightforward, like the
Correct.
PPMs, et cetera.
Yeah.
Like we both have
not
to put
rocket science.
all the information out there, so somebody should do that.
No, I think so. And I think the next 5 to 10 years, these larger institutions are seeing that a lot of people have an appetite for the private sector, and that a lot of people at the end of the day know you're going to make a lot of money in it unless you bought GameStop last Monday and sold on Wednesday, which was all luck. But I think that private sector is growing substantially with social media, and I think a lot of these institutions will start hopping behind it and creating a second platform that they can offer the private sector to their clients and keep and retain their management fee.
Yeah, I think that makes sense. And listen, I think if somebody can do that, especially the larger guys, and another way to provide liquidity, what's interesting about the feedback we get, even from accredited investors, is like, it's 5 to 7 years. I like the dividend. I like the dividends, but what if I need the capital? And so we're always trying to figure out ways we could solve for that. But it is tough, like in the space we're in, like it's hard to provide liquidity when we own a physical asset, and you don't want to be a forced seller either in the space you're in. So you want to give yourself some time horizons. But maybe some of these platforms, if you had quote unquote like a secondary market, and you could do it through some of these ATS platforms and stuff, but like then we would have to figure out a way to build both sides of the demand market.
Correct. Most definitely.
Because otherwise you end up, and we saw a couple platforms try this in real estate where like you have people, you tell them they have liquidity, they go to list their shares for sales, but there's no buyers. And so like if nobody's coming to the secondary market, it's not really a market.
It's irrelevant.
Right? So, I think it'll be an interesting next kind of 5-10 years in the space. I don't think it'll happen quick
no, it definitely won't happen quick. With the regulations and everything, I do think it will probably come, 10, 20 years from now. I think it will need to come because a lot of people are going to the private sector because they know if they invest in your fund that you have, you're probably giving them better returns, and if you're doing a cost seg on those properties, they're going to get a depreciation K1, if they can utilize that for their other passive income where, with stock market, you're not going to do that.
Yeah.
You can't do that.
What do you do? I'd be interested in your approach on, as we're marketing the fund, we show some of our properties, but, for your investors, how much of it is like showing them the car wash, showing them how car wash economics work, getting them excited about the actual asset, or is it primarily just the numbers?
No, I love that question. So when it comes to it, numbers are huge. We offer 10 to 12% annual returns with monthly distributions. No other opportunities offering that right now.
Right.
Plus, we give you tax benefits. And car washes have a very unique tax code with the IRS, which we are able to depreciate it. We can also take bonus and accelerated, but we can depreciate at a 15-year depreciation schedule.
Okay.
Where all other residential real estate's 27 and a half
Right.
years. So they love that. And our bigger accredited investors, they eat that up all day. Now, when it comes to people understand car wash, it is a newer asset to them. So the investment side is kind of uncharted waters. But they understand, I saw a car wash. I saw it very busy in my neighborhood. Right. So these have to be good investments. So we're seeing all of that. I think the big thing with the wash itself is that we invite all of our investors to come travel to the sites to see them, physically touch them. We just closed 2 last week. I was in Georgia for that, and we had a family office that came and visited the site with me, and we walked through the whole tunnel. We saw cars getting washed, everything. Yeah. So it's definitely a different approach in the car wash sector. It's a newer asset class. Some people understand it, some people don't, but they really like the numbers. They really like the high cash flow and high tax benefits, and marketing that can be a little challenging because a lot of people will see it and say, "Oh, is it a franchise or is it this?" And I think when it comes to the marketing aspect of it, it's super important to really be very detailed on the body of the paragraphs that you market on Facebook and Instagram, so people understand like this is a passive investment.
Right.
It's not active. It's a fund that has multiple deals in it, and I think it's going to grow even more because private equity is now getting a taste of cash flow and tax benefits. Yeah. So I think it's going to come and just grow substantially.
Yeah, that's smart.
Yeah, it's fun. Different asset class though. We love it, Will we ever go back into multifamily? I don't think so.
Yeah.
Because these offer high cash flow, high tax benefits. That's what we all want.
Interesting. How long ago did you get into the car wash game?
About a year ago, a little over a year ago.
Okay.
Yeah. I actually used to work at Sam's Express back in the day.
Really?
Yeah.
All
yeah,
right.
very much so.
I was a member for a while.
There
and
you
I
go.
think I was one of the ones you get a lot of margin off because I never used it, but I kept
Oh,
paying
yeah.
the bill.
There you go. Yeah, the huge profitability on that. But with our investors too, like we're one of our core values as a company is transparency. So we open up everything. But we've actually had a competitor try to work for us. I hired him, and come to find out, he was actually working for another competitor to steal our information.
Oh, wow.
Because the space is so small, just like your space. There's only I only know one other company in your space, and they have a different approach from what you guys do. I love what you guys do because you have options. You can sell them off as single family. You guys have options. Plus, you as a business approach, you have 3 different pillars. Where they just had one, and there's really no option to sell. But what I've definitely noticed is the space is so small. People are always trying to get your underwriting model because there's really no generic underwriting model. We had to build our 30-tab underwriting model from scratch. And then the technology we use to make sure they're good quality sites, that's something that a lot of people don't use. So they're trying to get our information. And that's another thing I want to talk to you about, technology. What do you guys do when it comes to, locating? Okay, obviously Charlotte's beautiful, but you're probably not going to go to the east side of Charlotte, or certain parts on the west side of Charlotte. So what do you guys do on technology to make sure, hey, these numbers make sense? Let's go ahead and purchase them.
Yeah, man, I think you probably realize the same thing. There's a ton of great data sources out there.
Oh, my God.
To at least trim down the thousands of available listing to hundreds, if not tens, of those that fit our buy box.
Mm-hmm.
And I think, we start with, I'll say, a hatchet of like, hey, listen, we're only buying, homes built within this time period. So in our case, like
you're not buying older homes. That's going to have a lot of deferred maintenance.
Yeah, exactly. In our business, specifically for our brand, we're happy to pay a slight premium for turnkey-ish.
Yeah.
Like we don't do fix and flips. We don't do structural stuff because what you run into in that sector in our space is building permit processes and stuff we can't predict.
Oh, it's ridiculous.
And so
plus good contractors.
Yeah, well, forget.
That's a whole
we
nother
still
story.
need that in some of our stuff, but we've been better lucky than good on that.
Good.
We call them master craftsmen, but basically we have like a Darwinistic process on that front too, where like if you do work for us, we are maybe it's like
it's not a one and done.
No,
like
it's
they know,
and it's the OCD in me. Like I say, like this is what I expect. The
100%.
the trim work there shouldn't be a gap between your cut joint. And here's how we caulk these things. And I was never a I
was gonna say, do you have?
No, but I was always I built a couple of my own personal homes. I built my home in Valentine Country Club with Arcadia, but I designed it myself.
You still live in Valentine?
No, I sold that in 2021
Oh,
to
perfect
move
time.
to the lake.
Perfect
I
time.
thought everybody thought I was crazy, but I'll tell you a quick story on that home. Arcadia did a really good job.
They're
on the
a
design.
beautiful builder.
Yeah.
I follow them on Instagram. Like they are a beautiful builder.
Yeah,
like,
Mike
a lot of
Salmon's
their
the
product.
founder, and I struggled because I bought the lot. I mean, this is going to sound crazy, but it was I think it was December of 2012.
Okay.
A lot popped up for $67,000
Oh my gosh,
in
are you
Valentine Country
serious?
Club, and I called the owner and I said, "I'll pay you all cash and I'll close tomorrow." Like on the lot.
And he probably was like, "Yeah,
and he was
take
like,
it."
"All right, sure, deal." And then it turns out like he got a bunch more calls right after me trying to offer him more, but he's just a nice guy. And he's like, "I already told him I'd sell
already
it."
committed.
And so we bought the lot. I didn't even know what I wanted to do with it. It was a pretty steep lot, but I've always loved volleyball, beach volleyball. And
Yeah.
so
You're a pro.
we put a beach volleyball court in the backyard. But
Oh, I
more
love that.
importantly, we built like a California modern-ish home.
That's cool.
And if you've been,
Which that's different
if your
than
listeners have
Valentine
ever
Country
been to
Club.
Valentine Country Club, most of it's like red brick,
Correct.
nice,
Old
beautiful
Southern
homes,
traditional. Yeah. You brought the LA
and
vibe.
so yeah,
in.
we stood out like a sore thumb. But I was building it for myself,
So,
and
as
like
long
I
as
was
you're
telling you, I
happy.
think the details I cared about. We did like museum quality baseboard stuff, which is like flush with the walls. And
love that.
we had 14,
So you were
14
really
foot ceilings
involved
and-
in that building process.
Yeah, but like I said, I love that part, and I didn't realize how much I loved it when I was working at Red Ventures because you're so busy in work.
Yeah.
But I was like, I think in life, the things you make time for because everybody feels like they don't have enough time.
Oh, 100%.
The things you make time for are probably the things you love, you love the most. So if it's your family,
Especially if
it's
you're as
sports,
busy
if
as
it's-
you are, and you're running multiple companies at a very high level, like that time that you make, even if it's for someone, that you're doing this podcast for, you're going out to dinner with, like that's quality time.
Yeah, and I think like if you just reflect back on your life, like those are probably the things you care about.
Oh, yeah.
Building relationships or helping the community or whatever it is. And so for me, like, I built that home, and everybody thought I was crazy because I think it was only 4,100, not only, but it was 4,100 square foot, which is kind of small in Bountiful Country Club. But I was like, what do I need a bigger house for? It's only like me, my wife at the time, and our daughter. And so had a pool on the second level. So you walk in, it was like a walkout basement. The pool was on the level. So anyway, even Arcadia was like, I think you're spending too much money for such a small house.
Yeah,
and I was like, well, I don't want to spend any more money. But I think I spent $1 million or something to build
That's
it.
cheap.
Fairly cheap at the
Now.
time. Yeah. And so like our neighbor's house was like 8,000 square foot or something.
Yeah.
And so when I went to sell it, I listed it at like 1.5 million. I wanted to move to the lake. I live on Lake Wiley now.
Okay.
And I wanted to, I really just wanted my kids to grow up with kind of a different experience. I loved the water as a kid growing up. And so I wanted them to have that. And the country club is great. And I love the location.
It puts you in a different state of mind. Like, I love the ocean. I love water. I meditate in the shower with the water, or the steam room at the gym. Like, that's where I do my meditation. It's just, for me, I'm the same way. Water, it's something that, like, it's a trigger in my mind where, like, I can just be calm.
Yeah, it kind of creates that peaceful place. And so, I listed it, and a couple saw the volleyball court, and in their vision saw like a basketball court in their backyard for their sons. I think they came from the West Coast.
Did they?
And they literally like a couple 100,000 above asking. And everybody thought like, there's no way you're ever
crazy.
gonna get your money back out of this house. And I was like, whatever. And I ended up selling it for a pretty good return.
There you go.
And so, I mean, I maybe better lucky than good, but I would say, long story short, like, attention to detail with your contractors
Most definitely
is almost the most important in our business, in hospitality, because like the little stuff matters
when
people are paying hundreds, if not thousands of dollars to stay with us. And
I mean, just the hotel I stayed at in New York, it was a pretty penny. Like, it was in Midtown, pretty penny for a night. All hotels in New York are now. And just going into the shower, I was like, they missed this. Like, they missed that. They missed this. Like, why? Like, if I owned that hotel, I would be in here making sure all of that was covered. Just the little things.
But I do think you're right. Like, as we scale, Eric Wu at Opendoor has this thing he talks about. It's diseconomies of scale. And so, interestingly, like in real estate, he believes, and we'll see. Hopefully, it's a good problem for us to have. But believes that, like, as you scale businesses that require real world operations, you can run into diseconomies of scale, which basically means like what you're really good at with a few properties is tough to stay really good at when you have hundreds or thousands of properties. And so you can get economies, as in like costs can come down. And he talked about it in Opendoor. You can get your painters, you can negotiate them down because you're giving them a lot more work.
Correct. But the quality,
the flip side happens is exactly like the quality falls off, because all of a sudden, Chris isn't going into every property. Somebody who works for Chris, who works for Chris, who works for Chris.
That's why I loved Costco's CEO. Costco's CEO visited every single property every single year. Now, he's no longer the CEO. He retired, but he had a beautiful private jet, Gulfstream, but he visited a property every single year. And the quality of Costco, I mean, I was going yesterday after church with my son, and I decided not to go because the line was out the door for the memberships. And I was like, look, I'm just going to go on a Wednesday, after lunchtime or something when everyone's, back at work. But they built that type of quality at Costco. You know what you're going to get. And I think you're right. And he's right. It's very difficult as you scale. And I always say, no matter what you do in life, there's a catch-22.
Yeah.
And so as you scale, you have to make sure you have that right, I like to say, auditing or secret shopping department of the company where they're visiting your properties. And one thing we do as car washes is we've noticed that customer service, the lack of customer service and lack of quality amongst the big name brands. So what we're doing is an auditing department that secret shops every single property, and then we grade our on-site manager. So our on-site manager, it's like if you go to a restaurant, we all want to eat at a grade A. Our on-site manager internally will have a certain grade, and then based off of a certain grade, they get a certain bonus too.
That. Yeah.
Because we want to keep that quality there, that type of customer service. That's why people go to Chick-fil-A. You know what type of customer service you're going to get. You know the quality. And if you're in Ballantyne, right off Providence, where I live, I see that line wrapped around. Now, I don't eat Chick-fil-A, nor I feed my son it anymore. But you see that line wrapped around, I know it's going to be less than 5 minutes. I'll get the food.
Yeah.
Because they have the systems, the process, and the quality is going to be the same.
You asked a question about technology, and I think Chick-fil-A, they've done a pretty good job amongst others investing in technology.
Phenomenal.
But I think fast food in general is on more the cutting edge of technology.
I mean, look, I just saw something on Wendy's. I think it was out in California, probably because it's $20 an hour out there. But I saw something where it's strictly 100% AI machine.
Yeah.
You go up and it was 100% AI. You tell them what you want, how large, boom, you're done.
Yeah.
Like no person at all.
I mean, I think you see the same in the McDonald's of the world, like going to kiosks. And I think it's a good thing for a lot of those like roles and efficiencies because it'll lead to other opportunities for people. But, for in our space, technology, you were asking about acquisitions.
Correct.
We use a lot of data, which is actually how we met originally. Like
That's right.
We were looking at a data provider together that
And someone introduced
referred us to you.
I'm glad he did.
Yeah, it worked out well. But I think data is data for data's sake, as Francisco, who's our growth officer, will say, is like not that valuable.
Yeah.
And so it's really a matter of like how you use it. So,
Correct.
We'll use data at the top of our acquisitions. Now, we haven't invested as much as we should probably on the acquisitions and underwriting side yet, but that's because today I can personally just underwrite every deal, with our CFO because we're only putting to work, $5 million in the next 2 months or 5 homes in our case. So it's like, listen, we're going to look at every deal ourselves. I'm going to make 100%. The decision. I'm going to visit it myself. But over time, like we'll have to use more and more technology. But I think the data is there for us to understand, like at the block level, or at literally this house, why will this house do better than the house across the street?
Most definitely.
And do we believe it or not? And like, every entrepreneur, I think, is very optimistic. Oh, yeah. And that's the tricky part about this business in particular and why I've tried to surround myself with people who are maybe more like the financial pessimist, if you will, or like a little more conservative is I think you kind of have to stay disciplined and conservative on the underwriting side. And,
you have to.
And the data lets you kind of say like, John, I know you love that property, but this is the data. Like this is what it says. And so like you can't trump it. And we have that rule internally.
100%. And we have that rule exactly same too with our company is that when we look at these car wash assets, we're signing recourse. I'm signing personally recourse on these things. And so we're not just saying, oh, we like this car wash, so we're going to buy it. No, I'm finding out every single thing about this area. We use a software called Placer.ai. I don't know if you've heard of them.
Yeah, I've heard of them.
They buy cell phone data.
Yeah.
So I'm able to see the trends of people in their movement, where they're staying overnight, everything, where they're working, all that, which is scary. Yeah. You haven't checked that site out, definitely check it out.
Placer's good.
Yeah, it's a wild site. It blew me away when I was looking at the demo. But we look at where people are moving to in and around our wash. I also then go granular. We love CoStar. We're a big CoStar advocate.
We use House Canary, which is like our version for residential.
Oh, nice. I like that. And with the car wash industry lately, everyone's been triple net leasing their land.
Okay.
So that's perfect. Why? Because if you go to buy a triple net lease, you have to look at the business's financials to make sure that you're willing, whatever asking price it is, it can justify it. So what do? We go look and find out all of our competitors on how they're performing on the site down the road, because mainly all of them are triple net leasing. We love to own our real estate because we're real estate guys at heart. But a lot of them are triple net leasing, so we're able to see the competitors' financials going that route too. But it's super important to really use that data to see, does the house across the street, is it going to perform better or not? What's going to make this different?
Yeah, and there is good data. There's a company called AirDNA, and there's a local company called Rabu, both kind of doing similar things for short-term rentals. Basically, I'm sure it exists in the hotel category. I don't know about it. Maybe your friend does, but they track every short-term rental, their occupancy, what are they charging per night, how are they doing on a revenue basis. So like we can go in, and I would say it's accurate, not precise, but it's accurate enough that you can kind of believe in the trends of the data. And so we can see, in Uptown Charlotte, okay, here's the other townhomes or the other apartments for rent on Airbnb. How much are they charging? What's their occupancy? What's the seasonality look like? And we can also say like, what would make our property stand out? And we call it the approach. It's like a very long acronym, by the way, but somebody can check it on our site. But I wrote it personally, and basically, we want properties that have something that makes them unique.
Yeah,
and it could be architectural, it could be the land, it could even be just the HOA. Like we have one where we control the HOA because we bought 2 of the 4 in a small area, and so so you own we wrote 50%. Up so like only Mansion can manage short-term rentals there. Yep. And it's like, okay, great, that's a unique asset, that makes it valuable for us.
Most definitely,
it's more qualitative, I guess. And so yeah, that won't show up in the data, but we can understand like what it would take in a given spot. And so instead of just saying purely, the data might tell us, this is a good deal. This home's for sale. Here's how many square foot it is. And we can also say like, okay, yeah, but like, are there 17 competitors right around us?
Correct.
And it's going to be tough to kind of stand out amongst it. Okay, like let's look somewhere else.
No,
for
I love
now.
that.
Or like we talked about earlier, nobody's really started rolling some of these folks up, but I think it's highly fragmented in our sector. Like most Airbnbs are owned by individual operators that have maybe 1, maybe 2.
Correct. Yeah.
That they've turned into it. And so not a lot of what I would say like professional businesses like
No.
ours.
I only know two, one
Yeah,
including you
yeah.
guys.
I'm sure there's more, but I think it's still none very, very large.
Oh, yeah.
And so I think there'll be a time where, you know, I've taken phone calls from people that are struggling with their business, or they thought it was going to be more passive than it is, and it's pretty active.
Everyone thinks that, hey,
Yeah.
this is passive, and they don't think it's going to be any active.
Until
But
they
then
get a phone
get
call
into
at
it,
2 a.m. on a Saturday.
and they're
That's
like,
it.
oh my God, I'm done with this.
Yeah. So, you know, I think we'll probably be more acquisitive depending on how the business does. We're starting to capitalize the OpCo a little bit more so we can be, you know, opportunistic
Good.
if those opportunities arise. But yeah, even using data there, like you said, we basically same way. Like if somebody has an existing Airbnb, they're trying to sell it to us. We're like, great, give us your transaction logs from Airbnb and VRBO for the last 2 years.
Yeah, let's see it.
We'll underwrite it and tell you if we'll do it or not.
Oh, most definitely. No, I love that. Let's talk. I know we have a couple more minutes. Let's talk about your leadership style. You are very relaxed, laid back. I like that. Hair is better than mine.
Maybe not today.
I love that. You know, we see the same vision when it comes to investing. You love to have options. I do as well. Talk about your leadership style and then how has that really evolved all the way from running your own agency to Red Ventures to, you know, now.
I would say, you know, at Red Ventures, I led teams of 0. Like I went to the UK by myself to set up our European operations.
That's
And I was
wild.
there for 9 months before we hired our first kind of CEO of our business over there, and then grew that team. I think now the team's probably 1,000 plus or something. And
Wow.
but I also led a team of 700 directly, like led a team of 700 at Red Ventures for a while. I would say I love to give people autonomy. And so I do really well in places where, you know, we can create, I like to call them like barrel shaped people. It's a Keith Raboy term,
Yeah.
but basically a barrel person. And I learned this from Marav, a lady at Opendoor who taught it to me, is somebody who can kind of take it end to end. So if I give them something, like they can do everything from the beginning of it. They understand the technology, they understand the operations, they understand the business case. They can come back to me with like, this is what it is. And so I've been lucky in life to be able to surround myself with those barrel people
Love that.
in every role that I've done. And I think it's because I love the building things. I love the vision. I'm happy to dive in. You know, I've been hands on keyboards, like coding our sites in Webflow lately. And just so I could prove to
that's
myself,
wild.
like, what could we do without $250,000 engineers? Like, I think with a lot of the AI tools, I just wanted to
You can
challenge.
get a lot done with AI these days.
Yeah, I mean, we had great engineers who worked for us for a while, but we can ship code faster. We can launch stuff faster today than we could 2 years ago when we had 2 full-time engineers. Today we have 0. And so a lot of that is literally just the technology is just kind of scratching the surface. But I would say my team would probably, I have high expectations, and you know, I lead with trust first. So I trust you inherently until like you lose it. And then I would say I definitely don't have like a 3 stars policy, but I think my fiance and my good friends would tell you, you know, I'm usually nice, and then just it's done.
Done.
Yeah.
Forget it.
And it's maybe not a good trait, but that's a trait I recognize in myself. And I like to kind of be working on every entrepreneur likes to be working on the newest thing, like the sexy thing. And so I have to catch myself and surround myself with people who can bring me the tough questions that are in the operations and in the daily business. So we have a new CFO. He's been amazing because he's like, this isn't good. You got to fix this. John, help us make a decision on this thing that I probably was ignoring, not because I didn't know it was a problem, but I was like, it's small enough.
It's not right now. I can handle it
I'm
later.
working on raising $25 million deal. I don't need to do this thing. And he's like, well, you do need to do it. But like, you can make the decision in 30 seconds. I don't need you to spend time on it.
I'm the same exact way. I'm like, if it's not like emergency, fire right now, okay, I'll handle it when it comes back up. But let me address what I need to address right now.
Yeah, and I really like developing talent. It was interesting. There was a time at Red Ventures, I won't say his name, but I led our paid search team, and paid search was like our most profitable industry or category at Red Ventures. And there was a guy who had been really successful. He was maybe 50 years old. He had been like the CMO of a very big business before, came to Red Ventures. He was kind of like not struggling, but wasn't doing as great as everybody had hoped he would do on the business. And our CEO said, like, you need to go learn paid search from John. And it had to, like, I can't imagine being in that position, but I thought like he handled it the best I've ever seen, where he was like, John knows more than I do about paid search. I'll go work for John for 6 months. I literally like taught him how to buy keywords in paid search, do AdWords. He's like 50 years old. I've been the CMO of a $100 million plus business.
He was coachable.
And he was like, I got to learn it someday. So like, who better to teach me than you? And so I'll do it. And I think, those are the people I'd love to have around me, because
You have to.
almost anything, right? Like the most frustrating thing for me on a team is when somebody comes to me with a question and they haven't Googled it themselves.
Oh my God.
And I'm just
That's
like,
one thing I say to everyone too is like, look, think of it before. Think of it of, okay, if I ask Chris this, what's he going to say? And now, thank God, everyone does their research deep. And if it's something like they just can't get over, then they come.
yeah. And I like, to me, those are the people that will be long-term successful,
100%.
right? Like,
100%.
and hopefully they'll be entrepreneurs. And, I think there's no executive I've ever worked with that was indispensable. And I tell my team the same, like, business is business, and you should try to make yourself indispensable to the point where, like, you can go do your own thing too. Like, if you tell me you're leaving for a better opportunity, I'm only going to be happy for you.
Yeah, go
and
thrive.
So, like, I would say that's my leadership style. And I've, there's a lot of great entrepreneurs. Like I was saying, even in Charlotte, there's this young woman named Christine Nicodemus. I think she's on her second startup. I think she sold her first one for like $80 million.
Oh, wow.
And she's building her second one now. I think the Charlotte Fund invested, and they just put an investment in Mansion as well. But,
Love that.
she worked for me. I think she was like an ops analyst for a few years. And I barely remember meeting with her, which is a good thing.
Yeah.
Like, I didn't have to. She just did it. She ran on her own, and I
That's
think
phenomenal.
that's probably the type of person why she's been successful. Is she just needed a little bit of like, what do I need to do? Tell me like my parameters, and like I got it.
I love that. I love that. Hiring people, in my opinion, there's no playbook for it, and it's very difficult to manage people. We all have different personalities. Everyone within our organization takes the DISC test, DISC, and then the 5 love language test too, so they know how to communicate, and that helps me too. So I know how to communicate with them as well. One thing I have found though through trial and error, in the previous company I ran was a 50-person agent team of residential real estate here in Charlotte. One thing I have found is that moving forward, I prefer to hire athletes because there is something in their intuition to just want to compete, their drive, their motivation. You give them a task, they'll get it done. And that's something I found is I've hired individuals that are not athletes, and everyone on the team now are athletes. I've noticed that drive. It's a different type of competitiveness that they have, and I love it.
Yeah, I mean, Red Ventures was the same, maybe less purposeful to start, more just like you surround yourself, right or wrong. Like a lot of companies surround themselves with people like themselves. But yeah, Red Ventures had a ton of athletes. Rick Elias is a great basketball player in his own right. We used to go to these fantasy camps.
Really?
He was like MVP after MVP, and he's the ultimate competitor. Ton of basketball players. But yeah, I mean, there's something there, and we're all biased in our own ways. But I was a college athlete playing volleyball. My fiance, plays professionally on the beach now.
Oh, still does?
Yeah. She
Very
represents
cool.
Team USA, so she's a good player.
Oh, I'd love to have her on.
Yeah. So she was from Bulgaria. Like, grew up, came here when she was 9 years old.
No
English
way.
was second language, but like super impressive.
We're gonna have to have her on if she's willing to.
I'm sure she would. She could probably talk about balancing that and having
dealing
three
with
young
a
kids.
very high valued man too, and dealing with the kids.
Yeah. Don't ask her about that. Part
No,
about the
no.
man part. But what I was going to say is that I think that there's the competitiveness for sure.
Yeah.
But there's also like that drive to want to be better internally. And
most definitely.
It's hard to, I think other people or non-athletes probably have it in their own right, whatever that skill is they're trying to learn. It's just easier to discern it from the outside in an athlete. It's
Correct.
like if you competed at a high level, whatever you want to call it, could be collegiate, could be professionally. Like, or at least aspire to do it.
Yep.
You put in work when nobody was watching to
100%.
get better. And like, that's the thing you can't judge. And it frustrates me when I hear, I have friends at the banks who are like, oh yeah, they monitor every minute I'm on my computer or not on my computer and whatever. I'm like, well, they're going to have a bunch of employees that are not going to be great players because like, there's no motivation to get better when you're not on your computer if the company's telling you we are just tracking the time that you're spending on your laptop.
I ran Division I track as a sprinter. And so when you're running a 60 or 100, 60, you're anywhere 6.5, 7 seconds, if you're all right, really 6 to 7 seconds. If you're 100, you're anywhere from, if you're really good in the 9s, but 10 to 11, 11 and a half. Those are the seconds, but we're training 3-4 hours a day.
Right.
And in the weight room just to run 11 seconds or 10 and a half seconds or 10 seconds, that short period of time, but we're spending hours on a daily basis to be able to compete at that high level. And that, that goes for, I'm sure with your wife, being a United States volleyball player, that's wild. And the Olympics is coming up too.
Yeah. So we have a 7-month-old and a 2.5-year-old, so she wasn't in this Olympic qualification cycle because she was pregnant most of the time.
Yeah,
but
next go around.
Next one's in LA, so hopefully she'll make a run for it.
Hopefully,
we
that
have a
would
lot
be
of good
nice.
friends out in LA, but that would be fun.
I love it.
But yeah, I think there's I like. I'm trying to think who's on our team, but we certainly have a lot of athletes on our team. We have a pretty small team. We have 8 people.
I love it small. We talked about this earlier. I love it small because you can really be nimble and you can pivot as well. But yeah, I love the athlete side, having athletes on the team.
I think we should all keep challenging ourselves.
We should.
Somebody said that there's also going to be the next $1 billion. There'll be $1 billion business with like one employee. I don't know if it'll be one employee, but with all these AI tools, I certainly think we should see people becoming more and more efficient.
I think billionaires are going to be, that's just going to be a norm, just like millionaire. I think that's going to be a norm. Oh, you're a billionaire. And then I think in yours and my lifetime, we'll see a trillionaire, and it'll probably be Elon because he hasn't taken SpaceX public.
Yeah.
And I think
and most people don't realize how much money how much potential there is in space. I think he does.
I think he does 100%. And then, I mean, even if you look at, Arabs out there that dealing with oil, Amco, all of that, those individuals have a tremendous amount of capital. They just don't like to flaunt it in certain ways of being on Forbes and things like that. Even Elon would say.
We should have another call. I'd love to hear your story another time around.
Let's do it.
Raising capital, because I think there are a lot of categories where it's tough. I would say in the VCs, it's funny because I had VC calls and they have LPs, right? Like they're basically capital allocators, but they're raising capital from LPs. And part of what I said in the story was I said, okay, I'm only going to take VC capital, but I want you to introduce me to your LPs to invest in my real estate fund. Mm-hmm. If you're not willing to do that, then just raise your hand and say we would never do that, and we won't waste your time on a call. And I bet you 75% say we would never do that. Mm-hmm. And it was because they felt protective of like, no, that's our relationship. We don't want to introduce you to it. And it's interesting because when I talked to a local VC, he's like, no, the one who invested in us, he's like, no, that's part of our whole thing. Like, of course, I want you to be successul. If they want to put money in real estate, it's not competitive with my venture fund. Most definitely. Like, so sure, I'll introduce you to every LP.
So we get asked that from the big players. Last Thursday, I was in New York, met with $1 billion family office to discuss investment into our car wash. And I introduced him to another $1 billion family office out of Naples that are partnering with us on the car washes. So we have a couple investors that I've already had those preliminary talks with. Is like, hey, if we have an investor that wants to talk to you, would you be open to telling them, exactly about our relationship, everything, there's no hold back. You can tell them whatever they ask. And they've all said yes. Yeah. So we do offer that.
That's good.
But I know that those individuals, if they try to like poach them, I know those individuals are going to come back to me and be like, look, like, don't do business with this guy. He's just trying to take me to do something on his deal. And so that's how close we are with a majority of our LPs. A lot of them are extremely busy doctors that, they don't have time for calls. But the ones that I know that will make time for us, and obviously, I take them out to dinner, things like that. I make sure their time's well spent. They're more than happy to have those calls, but we have such a tight relationship with them that they're going to say, hey, so-and-so was trying to get me to invest in their deal. And, I don't know if you want to do business with someone like that.
I think that's great. I think that trust is everything, especially in our business when people are trusting us with their money too. So.
You have to have it. Most definitely. Well, John, I really enjoyed having you on. Excited to have you on in the future, once you've built everything. Thanks so much for your time. I really enjoyed it.
Thanks, Chris. It was fun.
Thank you for tuning in to the Chris Salerno Show. We hope you enjoyed today's episode and gained valuable insight to help you along your journey. Don't forget to subscribe and leave us a review on your favorite podcast platform. If you have any questions or topics that you would like to cover, feel free to reach out directly to me. Shoot me a message on Instagram at Chris_Salerno_. Until next time, keep pushing forward and stay inspired.